Hey everyone, and welcome back to the channel. If you're an investor in dividends or just looking to get passive income, chances are you've seen the eye-popping yields from ETFs like YieldMax. We're talking 30, 50, even 70+% dividend yield.
Do not touch those! Those are not to be touched by anyone but us or me!
In this video, I'm breaking down exactly what high-yield ETFs like YieldMax are, how they generate massive income, and most importantly, the risks you need to know before investing. Stick around, because the real danger isn't what you see, it's what you don't.
Hey, wait a minute. This ain't a trick, is it?
YieldMax isn't your average ETF. These funds use option strategies, specifically something called covered calls. Here's what that means in plain English. They try to generate income by betting on the price movement of big-name stocks like Tesla, Apple, or NVDY, but they don't actually own the stock. They use derivatives to mimic it. They then sell call options against that position, which earns income if the stock does not skyrocket. The result? Being high monthly income paid out as dividends from the premium they generated by selling the covered calls. So let's talk about why people love these ETFs. Number one, the massive yields. We're talking about a minimum of 50% plus annualized dividend payouts. Some, like I showed in the beginning, have up to or over 100% of the yield that you invested into the stock will be paid out to you again in dividends by the end of the year. Also, second on the list, monthly income. It's great for retirees or just investors who want a little bit more of that income coming in. It's also pretty easy. There's no need to manage the options by yourself. The fund is already managed and it does all the complex stuff for you. It's also just a set or forget. You just buy it once, forget about it. You can buy them on most brokerages, Robinhood, Fidelity, or Webull. And based off of that, it sounds like a no-brainer, right? Well, here's the twist. Now it's time for the part most people skip over. Up first on the list is going to be capital decay. So these ETFs don't actually hold the stocks. So over time, due to how options behave, the NAV, aka net asset value, can go down significantly while they hold the options. So while you're collecting those big monthly payouts, your actual investment is most likely going to be bleeding in the background. For example, TSLY launched in 2023 and it's paid out a massive amount of dividends. But it's also lost 20 to 30% of its price. Next on the list, there's no long-term growth. Since these ETFs are constantly trading short-term options, they're not able to capture the long-term upside of the stock. Say, Apple goes up 40% over 2 years. APLY will not. It may be paying out the same amount in dividends, but that stock price itself is definitely not getting the same boost. Third on the list, the dividend is not guaranteed. The yield is always going to be variable. If market volatility drops or option strategy underperforms, the payout can drop too. And when that payout drops, everybody who has been investing for the income will most likely try to save their money by getting out as fast as they can. And last but not least, the tax complications. Don't want to be in trouble with the IRS. These payouts may be considered as non-qualified dividends or even a return on capital, which means you could have an unexpected tax bill or even basis adjustments that you weren't expecting. So are these ETFs something that you should avoid entirely? Not necessarily. These ETFs can work for income-focused investors who do understand the risk, people who use a small portion of their portfolio just for yield or income, or short to medium term plays in a sideways market. I know that hasn't happened recently. It's been very, very up and down, but during the times when volatility is at a low, these can provide the extra income. But now let's talk about who they're not ideal for. Any long-term retirement portfolios, this is not going to be something that you want. It's going to be bleeding the stock price itself while you're getting taxed on the dividends you're being paid out. Not a good thing for retirement. Up next, investors investing both income and capital appreciation. If it's one or the other, there are ETFs that specialize in either of those. But for a YieldMax account, you're really only getting the income. There's no capital appreciation, even mostly capital depreciation. And last but not least, anybody who doesn't understand how options or the NAV erosion works. I will make a video about NAV erosion a little bit later, but until then, just don't even play with them. The bottom line and the point that I'm trying to make here is that high yield ETFs like the YieldMax are powerful tools, but only if you know what you're getting into. You can't get hypnotized by that big fat 112% dividend yield without understanding the strategy, the drawbacks, and how it's going to affect the long-term outlook of your portfolio. So use them wisely, and they can complement your portfolio, but use them blindly, and they can erode your wealth faster than you expect. If you found this helpful, don't forget to like, subscribe, and drop your thoughts in the comments. Do you invest in YieldMax or similar ETFs? Would you consider adding them to your portfolio? Drop them down below. Thanks for watching, and I'll see you in the next one.